Okay, hi everybody. So this video should be sort of 40-minute range, maybe a little quicker. We're going to look at statement of cash flows, and I just want to show you sort of the anatomy of our statement of cash flows. And just first of all, I want to talk about why we are doing this fourth statement. So we've done income statement, statement of changes equity, and balance sheet. But the statement of cash flows reveals a lot about a company. First of all, it reveals whether or not it has a healthy cash flow and enough cash flow from its sort of basic operations, like sales and costs of sales, to sustain itself, basically pay its bills on time, pay interest on the long-term debt, etc. So it's an important statement, but it's sort of somewhat separate from the first three statements that we've done so far in the course. So this is an example of one of the solutions we have for one of the questions I'll do in a minute, of a statement of cash flows. So it's for DCA Corp statement of cash flows. There are three main sections, so I want to describe them and explain them a little bit. CFO stands for cash flow from operating activities, or cash flow from operations. So before I get into detail about this, we'll describe the other two. CFI is cash flows from investing, and CFF is cash flows from financing. I want to just give you a quick diagram about the meaning of these three sections. So to do that, we'll take a quick look at a balance sheet. So in our balance sheet, we have an asset section, we have liabilities and equity. Our asset section is comprised of our current assets and also PP&E, so current and long-term. And then we might have intangible assets. Those are long-term, more or less. They're almost always long-term assets. So we want to divide our assets into current and long-term assets. With our liabilities section, we'll have current liabilities and long-term liabilities. And equity, of course, normally we have our common shares, we might have preferred shares and retained earnings. So, in our statement of cash flows, the first section, our CFO section, deals with a net income amount that I'll show you this method in a minute, as well as changes in these two sections, current assets and current liabilities. CFO section. This is theory. You really don't need to jot this down. You can refer back to the video. I just want to give you some context and meaning to the statement of cash flows. What you'll really need to know for the exam is how to create a statement of cash flows, probably from scratch. So not to worry, we'll get it organized so that you know how to do that. CFI section deals with cash flow changes with long-term assets. So CFI. And CFF deals with your financing activities. So it has to do with your long-term liabilities as well as any changes in shares. So CFF. And retained earnings sort of has a little bit to do with that as well. Okay, so I'm going to come back to this diagram, but what I want to do now is show you the mechanics of how to create a statement of cash flows. To do that, we need to go and look at more information about our changes in our balance sheet. But this is the final result of a statement of cash flows. Sorry. For our CFO section, this is called the indirect method of creating the CFO section. The textbook also mentions the direct method, but you won't need to know that. So for the indirect method, we start with our net income amount, which we take from, of course, the income statement. So there's our net income, and we're going to add and subtract changes to our working capital. Working capital, let's see, I'll just jot this down over here. Working capital is a term that means our current assets and our current liabilities. So working capital, again, is current assets and current liabilities. So we're going to note either an increase or decrease in accounts receivable, in our inventory, in our accounts payable in this example, and in our income tax payable in this example. So we'd have a longer list for some companies and various accounts, whatever is in the current assets and current liabilities. So just to recap, we start with net income. We record changes in our working capital. And we're also going to add back any non-cash expenses. So the two non-cash expenses we've had so far in the course are depreciation expense and bad debt expense. We normally add back any depreciation expense because to arrive at this net income amount, we had to subtract depreciation expense, but we didn't spend any cash on depreciation. So that's the reason that we are adding it back. So to get our CFO, net cash inflow or outflow from operating activities, we add and subtract this whole column of amounts, and we end up with this positive amount for CFO. For our investing activities, we look at anything we buy and sell as far as the PP&E goes. So in this example, we purchased equipment and we spent $16,800 cash on buying the equipment. There's only one item there. There's usually only one or two items, and that is our CFI amount. For financing activity, we'll record any new long-term debt or any long-term debt that we completely paid off. We'll record any new common share issues. And we also record dividends paid in this section. So you would have that information, would be able to figure it out. So in this case, we issued additional common shares, so we received cash for those, and we paid out dividends. So these two amounts combined together give us our CFF, cash flow from financing. So we'll add these three amounts together. When we add these three amounts together, we will get this net increase or decrease in cash. Usually it's an increase. So to reconcile the statement, we need to add two more items. We're going to look at the balance sheet to get our beginning cash balance for the year. So this is for the year 2020. What we would do is look at the ending balance, ending cash. That would be December 31st of 2019. So we'd put that either end of 2019 or beginning of 2020, same thing. Put that amount and make sure that this amount, when we add it to our beginning cash balance, will equal our ending cash balance that we have on our balance sheet for 2020. So that is the overview of our statement of cash flows. Now what I'd like to do is show you how to create this with one or two examples. So I'm going to show you a very simplified example first, and then we'll go back and do that DCA example. So typically what you are given in these questions is a comparative balance sheet, and by comparative what it means is we're comparing 2 years. So in this column here we have ending balances on the balance sheet for the end of 2017 and end of 2018. So make sure you read this carefully. This amount of retained earnings should just be over here. So just make sure you read these dates carefully so you're reading in the right order. So anything that we have here is the same as the beginning balance for 2018. This is ending balance for 2018. We also need to look at our income statement. So on our income statement, this is a very abbreviated income statement. We're going to see either a net loss or a net income amount. In this case, we have a net loss. And usually what we do with a more detailed income statement is look to see what the depreciation expense is, because that is an item we will add back in our CFO section. Okay, so let's go down and do the CFO section with this information that we have. So for our CFO section, we start with either net loss or net income, whatever we're dealing with. So in this example, we have a net loss. So I put brackets around that to show it's a negative amount. And now what we're going to do is look at our working capital. So these three items are our working capital. I'm going to go up to the comparative balance sheet and have a look. So you'll notice from during 2018, during the year, our accounts receivable decreased. It went from $7,000 to $5,000. So that is a decrease of $2,000. When our accounts receivable decreases, it means our customers are actually paying us more cash. They're paying it a little more quickly. So we want to see a decrease in accounts receivable. That's a good thing. Down here in our CFO, we'll record decrease in accounts receivable, and that's a cash inflow. Cash inflow of $2,000. So we write it as a positive amount. Let's look at our inventory. We'll compare our balance sheet amounts. Our inventory started the year at $6,800, but it increased to $9,500. So what does this mean? This means we're not selling our inventory fast enough. Ideally, we'd like to see this as the same amount, or even if we're selling more inventory than we're buying, the inventory amount will go down during the year. But the inventory amount is going up. That means the inventory that we're buying is a little bit too much. We're not selling it fast enough. So that means that this is, because we're buying more inventory, it's a cash outflow. We're spending more money to buy additional inventory. However, we're not selling it fast enough. When there's an increase in inventory, it's recorded as a cash outflow. So the difference between $6,800 and the higher balance of $9,500 is $2,700. So that is a cash outflow of $2,700. I'm going to write a little key for you that makes this easy to remember. The last item in our working capital, so this is just current assets and current liabilities. So this is change in any current asset or current liability. The last item is accounts payable. So furniture is not a current asset, so we're not looking at this for our CFO or the accumulated depreciation. But accounts payable went up, so it started at $3,200, ended at $4,100 for the year. This is actually a good thing. So what it means is that we owe more, but it means we're hanging on to our cash. We're not spending our cash to pay down our accounts payables. So as long as there's no penalty for increasing our current liability, we're good. It means we're preserving cash and hanging on to a little bit more cash rather than paying off our accounts payable quickly. Generally, companies do this. They like to postpone paying any accounts payable for as long as possible without penalty in order to make the best use of cash for the company. So the difference here is $900. We're going to record that as obviously an increase to accounts payable, and that is $900 will be a cash inflow. Okay, I'm going to show you the key in a second, but we'll just do the final item here. Our depreciation expense normally would have been listed with our list of expenses on the income statement here, but it was just down here as a little note. So depreciation expense was $500. Depreciation is always a non-cash expense, so we do need to add that back. That's a cash inflow. So to get our CFO, net CFO, amount right here, we start with negative 900, add 2,000, subtract, add. Our net CFO is negative $200. Okay, so just a little bit of help with figuring out this change in current assets and current liabilities. I'm going to note this up here. When we have an increase in any current asset, it's a negative cash flow. When we have a decrease in any current asset, it's a positive cash flow. And the opposite is true with our current liabilities. When we have an increase in a current liability, it's a positive cash flow. And any decrease in a current liability is a negative cash flow. So this is your key. And you actually don't have to remember all four items here. So if it was me writing the exam, when it comes time for the exam, I would only remember the first one, and then everything is opposite to the first one. So if you can remember that an increase in current assets is a negative cash flow, then logically you know that the opposite would be true. A decrease in current assets would then be a positive cash flow. So if you can write this first one, you'll have the second one, and then current liabilities behave in an opposite way to current assets. So an increase in a current liability would have a positive cash flow, not negative. And then the opposite would be true with current liabilities. With a decrease, you would have a negative cash flow. So hopefully that helps you when you're working through a statement of cash flows CFO section. So this applies to the CFO section only. Okay, so for our CFI section, we're only looking at PP&E. And what happened here was that, first of all, there's a little note here. It says furniture was purchased for cash. So we didn't buy the furniture for an accounts payable because we're only recording changes in cash. No furniture was sold, which makes it easier. And we can look up here and see that our furniture, we want to look at the cost. So we don't look at accumulated depreciation or net. Our furniture went from $11,000 to $14,000. So we spent $3,000 buying new furniture. So we'll note that under CFI, purchase new furniture. That's a cash outflow, obviously, because we spent money on furniture. So our CFI is negative $3,000. CFI section is usually pretty straightforward, usually just one or two items, a purchase of a PP&E asset and maybe a sell as well. For our cash flow from financing, there's something that we need to calculate here, but let's look at, again, this would be any long-term liabilities, any changes there, any changes in common shares, and any dividends paid. So let's have a look. It looks like there was an increase in our common shares. So we issued additional common shares for $5,000. We went from $10,000 to $15,000 during 2018. So we will note we issued common shares, and that's a positive cash flow, $5,000. So as far as dividends go, there's nothing here that notes dividends, definitely not on the balance sheet. And we don't have any notes about dividends. So how are we supposed to know our dividend amount that we paid, if any? So what we do to figure out the dividend amount is we use that column in our statement of changes in equity. So I'm going to write it horizontally, if you don't mind. So our beginning retained earnings plus or minus any net income or loss in this case, minus any dividends paid will equal our ending retained earnings. So this is the same as the column in our statement of changes in equity. Our beginning retained earnings, if we go back to the comparative balance sheet, was $11,800, and our ending was $9,900. So beginning here, 11,800. We're going to we have a net loss here, so we'll subtract $900 here. We're going to subtract any dividend amount that we paid, and that will equal our ending retained earnings, which is $9,900. So how much is this amount? You just need to use your calculator. We take 11,800, subtract 900, that's 10,900. So the dividend amount that must have been paid would be $1,000 in order for us to arrive at our ending inventory. So that's how you figure out your dividend amount, okay? So going back to our CFF section, we did in fact pay dividends, and they are negative $1,000. So our CFF section altogether is a cash inflow of $4,000. We take these three amounts, CFO, CFI, and CFF. We add and subtract together to get our net change in cash, which is positive $800. Okay, so 4,000 minus 3,000 minus 200 would be $800. What's the beginning cash balance? This is beginning as in January 1st, 2018. To get this amount, we go back to our comparative balance sheets. And we have our beginning cash balance and our ending cash balance. Beginning is $1,200. And then there should be a line right here. So our change in cash plus the beginning cash balance should equal the ending cash balance. If it doesn't, then there's a mistake up in one of these three sections. But we're good. Our ending cash balance is $2,000, and there it is in our balance sheet. So let me move on to at least one more example with the time that we have, to show you a little bit more complexity in the statement of cash flows as part of your prep for the exam. Let me see. Are they going to do Betsy or DCA? I think we'll do the DCA that I had showed you earlier. I have uploaded, I think, 4 or 5 statement of cash flow examples for you, and Professor Baxter will be able to go through at least one, maybe 2, with you in your Thursday class. Okay, so what we have is our income statement for the end of the year 2020. And we have our comparative balance sheets. Noting carefully, it's for the end of the year, end of 2019, end of 2020. So how do we create our statement of cash flows? If we have to do it from a blank sheet, which I think I will show you, then we want to start by, okay, I'm just going to abbreviate this. So statement of cash flows, you could put DCA Corp, and this would be for year ended December 31st, 2020. By the way, after I show you this example, there's one more item we need to talk about, and that's interpreting the statement of cash flows, which is really the most important part. But if you just have a table or a blank page on your exam, write the heading. You're going to write 3 sections. CFO, you leave a little bit of space. CFI, down here a bit further, and then CFF is your final section. Okay, so CFO always starts with net income. There's almost always, you're going to be adding back a depreciation expense. It doesn't really matter what order you write these in, as long as everything is there. So we know that these 2 items will be there for sure. And then we'll note any increases or decreases in our working capital. There's one more item that I haven't mentioned to you yet, which would show up in our CFO section. And that item is if we sell a PP&E asset, and if there's a gain or a loss. So not the entire money that we got from selling the PP&E asset, but just that little gain or loss amount would also be reversed, actually, in the CFO section. So there's another example that will illustrate that. But otherwise, we have net income, depreciation expense that we'll add back, and changes in working capital. Okay, let's take a look at our income statement. So we have net income of $93,800. So I'll jot that down here first. 93,800. I would think about writing this in two columns. Not all of the examples have two columns, but I would write subtotals in an inside column and then write your total CFO, CFI, CFF in the outside column at the bottom here. Okay, next we want to add back our depreciation expense. Take a look. There's our depreciation expense, $25,200. So 25,200. Great. And now we want to take a look at changes in working capital. I'm just going to take this off of the document for a sec. All right, so let's just sort out which items here are working capital. The items that are working capital are our accounts receivable, inventory, not equipment or its accumulated depreciation, accounts payable, and income tax payable. So these are the current assets, these are the current liabilities. So using the key that we did on the example before, any increases to current assets, what did I write down first? Increases or decreases? Any increases to current assets would be a negative cash flow. Any decreases to current assets would be a positive cash flow. Okay, so what do we have here? Accounts receivable has gone up. That will be a negative cash flow. Inventory has also gone up. That'll be another negative cash flow. So what I'll record on our statement of cash flows, I'm just going to sort of write it shorthand here. We have an increase to accounts receivable and an increase to inventory. So you just simply take the difference between these two amounts. The difference is $5,600. That's a negative cash flow. Difference between these two inventory amounts, $35,000. Okay, so that's it for our current assets. For our current liabilities, any increase in current liabilities, positive cash flow, any decrease is negative. For our accounts payable, we've been paying off our accounts payable, so that is a negative cash flow. Our income tax payable has gone up a little bit, so that relates to a positive cash flow. So let's record both of those. We have a decrease in accounts payable and an increase in income tax payable. So the difference in these two amounts for accounts payable, $12,600. So that is a cash outflow, $12,600. And our income tax payable went up by $1,400. That is a cash inflow of $1,400. Okay, we have all of our amounts. We did not sell any equipment. So at the bottom here, equipment was purchased, no equipment was sold. Therefore, we don't have to worry about a gain or loss. If we had a gain, if we did sell equipment, and if there was a gain, we would say gain on sale, and we would subtract the gain amount. The reason for that is because the gain amount had been included in this net income amount. We have to take it off, and we're putting all of the cash flow from the sale of any PP&E asset under CFI. If we sold equipment and there was a loss, we would add back that loss for the same reason. So I'm going to say that once more. If we sold an asset, there was no sell in this example, but if we sold a PP&E asset for a gain, we would subtract the gain here. If we sold an asset for a loss, we would add back, we'd say loss, and we would add back the loss. Okay, but we are finished with our CFO section. So we're just simply add and subtract our total, so we can say our net. You could write net change in cash. There's no really formal line item here. CFO, once we add and subtract, would be $67,200. So let's move down to our CFI section next. So once again, all we know is that we purchased equipment for cash. So all we need to do is take the difference between our equipment costs, this amount, $138,600, taking the difference here. It looks like we purchased equipment and then the difference is $16,800. So we would write here purchase equipment, and when we're buying equipment, of course it's a negative cash flow when we're buying equipment, $16,800. So there's no other buy or sell. So we can just say our net CFI, that's enough to say that. Put a line here just for consistency, negative $16,800. And then our last section is CFF. So this is where we look at long-term liabilities and changes in common shares and any dividends paid, which we'd have to figure out. So let's look at our balance sheet again. Do we have a change in our common shares? Yes, we do. Common shares has gone up. So we've issued additional common shares, and the amount of the increase is $28,000. There's no long-term liabilities listed at all in this company. So we don't have to look for any change in long-term liabilities here. It's only the common share increase. So let's note that here, that we issued common shares. When we issue common shares, we receive cash, so that's a positive amount. And usually there's a dividends paid. So to figure out if there was a dividends paid, and if so, how much, we're going to do the same thing we did in the earlier example that I showed you. So I think what I'll do is write that just down here. So we'll look at our beginning retained earnings. We're going to add net income. We would subtract any dividends paid, and that will give us our ending retained earnings. Okay, beginning retained earnings, where's that? It is right here. So 40,600 plus our net income was 93,800 minus any dividend paid would equal 82,600. So if we figure all this out, we add these together, it's going to be over $130,000. So to get down to the final ending, the amount of dividend paid would have been $51,800. $2,800, just quite a large amount. Usually it's not that high. Okay, so we have this amount. That'll be a negative cash flow in our CFF. So paid dividends, paid cash dividends. Obviously, it was a stock dividend. There'd be no cash recorded on this statement. This is only for cash flows, not for every activity that we have during the year, only cash flows. So this is negative, or rather cash outflow, 51,800. That's it for our CFF section. So our net cash flow for CFF would then be cash outflow of 23,800. We want to draw a line here, and then we'll do our final 3 lines of the statement. So we want to add these 3 items together first. CFO, CFF, CFI, CFF is the net. You can write net change in cash if you're not sure if it increases or decreases. In this case, it's an increase, and the net increase with these 3 amounts added together, 26,600. Okay, the next line is cash balance at the beginning. Or you can write January 1st. So to find that, we go back to our comparative balance sheet. There's our beginning cash balance, 54,600. Because we're dealing with 2020. This is the end balance for 2019, which is the same as the beginning balance for 2020. So 54,600. And this is to check to make sure we've done everything right. So our cash balance at the end, so I'm just going to write down, this would be January 1st, 2020. This would be December 31st, 2020. You don't have to write that, I just wanted to illustrate. So we add these together. When we add them together, we get 81,200. So is that right? We go back to our comparative balance sheet, and yes, it is 81,200. Okay, so I think with the time I have left here, this has been about a half an hour. Great. I'd like to show you one more example with a little bit more complexity. Just a little bit. So we have a choice of West Corp. Yeah, we'll do West Corp. Okay. I'm going to move on a little bit more quickly with the first parts of this, now that you have at least 2 examples of statement of cash flows in this recording. So one moment here, take this off. Okay. All right, so West Corp. We have net income, which is great. We have a depreciation expense, so that's given for us. We have our comparative balance sheets. Just read through the notes here, see what's going on with our balance sheet. Common shares were issued for cash. Sometimes common shares went up. Sometimes they're issued in exchange for something non-cash, like a building or something else. In this case, we do have a change in our long-term liability, which is a 5-year note payable. So these 2 items belong in our CFF. And this note payable, there's a big chunk of a note payable that was paid off. So we're going to record that cash flow. New equipment was purchased, and it told us the cost. By the way, I need to point out here, in this example, this is not from the textbook, but this cost of the new equipment is just coincidence that this amount is the same as the depreciation expense. That's just strictly coincidence. They're not related at all. So I don't want you to be confused by that. I'm sorry that this example just had that similarity, but purchase is usually just a random amount, whatever the PP&E cost. here's where we have to iron out a wrinkle here. So other equipment was sold during the year. It had a cost of $58,000, so we have a buy and a sell. We know what the gain is, but we don't know what amount of cash we got for that equipment, so we have to figure that out. We have to figure out dividends paid, and here we have to figure out how much cash we got for the equipment sold. So to do that, we have to jot down a couple of T accounts. Okay, let's begin our statement of cash flows. So let's see. CFO. So this is West Corp. Statement of cash flows, December 31st, 2020. We have our CFO section. We start with net income. We're going to add our depreciation expense, and then there'll be another number of other items. A little further down, you might want to wait to write this next section, wait until you finish this, but we'll have our CFI section, cash flow from investing, and then we'll have our CFF. Okay, what was the net income? It was $104,112. Depreciation expense was $70,320. Okay, then we're going to look at our working capital. For working capital, we have accounts receivable, inventory, prepaid expenses is a current asset. We also have current liabilities, accounts payable, wages payable, income tax payable. So those are the current assets. These are the current liabilities. We have 6 of them. So just for the sake of time, you guys have this handout, and you can work on doing the math of the changes as you review this video. I'm going to jot down all of our working capital, starting with the current assets. So there was an increase in accounts receivable, there was a decrease in inventory, and we had an increase in prepaid expenses. For current liabilities, we had a decrease in accounts payable, decrease in wages payable, and a decrease in income tax payable. So we'll take the difference with those 6 items and note them here. So an increase in a current asset is a cash outflow. This means that the customers are not paying us quickly enough. The decrease in inventory is a cash inflow. It means that we're not buying as much inventory to maintain those levels. Our inventory is actually going down, so we're spending less money on buying inventory, which equates to a cash inflow, cash savings in a way. The increase in prepaid expenses was only $240. The decrease in accounts payable means we're paying off more of our accounts payable. The difference in our balance sheet amounts is $7,200. The decrease in our wages payable, the difference in our balance sheet amounts is $10,800, and in our taxes payable, we're actually paying off more in the way of taxes, $1,440. Okay, we do need to take a look at the equipment item. So we sold equipment. In the notes, it said here, the equipment was sold during the year. It had a cost, originally it had a cost of $58,320. There was a gain of $2,400. We need to jot this gain down in our CFO section. So gain on sale, you can put gain on sale of equipment. And because it was a gain, which had been included in this amount, we need to take that gain out of this amount. So we're going to subtract the gain amount. And that's so that all of the cash flow from sale of equipment will be reflected in the CFI section. So that's it for CFO. We'll add and subtract everything here to get 166,752. Okay, let's do our CFI section next. So there are two items in CFI. With equipment, just PPD, so we bought some equipment and we sold some equipment. So we can say sale of equipment and purchased equipment. Okay, so let's go back and see if we have information of either of those items. We need to figure out the cash we got when we sold. But up here it says new equipment which was purchased at a cost of $70,320. This should say for cash. That was an omission, but this is actually for cash. So let's make note of that. Beside purchase equipment, $70,320. So we need to figure out how much money we got when we sold the equipment. And that's sort of a separate calculation, which I will show you now. We need to create two T accounts to show us what's going on with the equipment. We need to show equipment, and we need to show what's changed with the accumulated depreciation for the equipment. Okay, so to get an accurate record of what's going on, we need to go back to our comparative balance sheets. So our equipment started the year at 100, so this is, again, end of 2019, which is the same as the beginning of 2020. Equipment is an asset. We put it over on the debit side. That's our beginning balance. The ending balance in equipment is 156,000. So I'm just going to leave a little space and just jot down that our final ending balance was 156. The equipment that we bought, you can see in this note here, had a cost of 70,320. So we add that to our equipment account. So you can see this doesn't add up. So we need to subtract the amount of equipment for the equipment that we sold, which was the equipment was sold during the year, which had a cost of 58,320. So as you know, so 58,320. The equipment account is all costs. Accumulated depreciation account is where we track the accumulated depreciation, obviously, but it changes. This is where the change happens from one year to the next. So our accumulated depreciation account started the year at 12,000. It ended the year at 33,600. We had depreciation expense, and it's very unfortunate that it happens to be the same amount as this new equipment we bought, but the depreciation expense is, as you know, when you write the journal entry, it's a credit. We write depreciation expense when we write a credit to accumulate depreciation. So we'll record that credit amount in here. That was our depreciation expense from the income statement. Okay, so we're missing something. We're missing the amount that would go here when we sold the equipment. So as you know from what we did in Chapter 6, when we sell the equipment, we write a journal entry. So I'm going to jot down this journal entry quickly because you need to do that as well to figure out the cash flow. So our sale of equipment has a cash debit. It has an accumulated depreciation debit. It has a credit to equipment. And in this case, we have a gain. So let's fill in the amounts that we know for sure here. Our gain was, let's do the equipment first. The equipment that we sold during the year had a cost of 58,320. let's a credit here, 58,320. It had a gain of, let me double check, 2,400. Okay, so we need these debit amounts because we don't know the cash we got, and we have to figure out the accumulated depreciation. So this is where we figure it out, right here. So in order for this T account to work out, we need to fill in the amount that belongs over the debit side in order to arrive at this final balance of 33,600. That amount will be 48,720. So now we've got that, 48,720. And so what amount of cash will make this journal entry agree? So we need to add up what we have in credits. We have a debit that's only 48,720. So the amount that we would have received in cash would have been $12,000. And now our debit amounts equal our credit amounts. Okay, so there's lots of steps here to finally get to the amount of cash we got when we sold the equipment, which is 12,000. All right, so where did I leave the? So we're going to come back to our CFI. The sale of equipment, we now know that we got 12,000 cash. And that's it. We only bought equipment and sold equipment. CFI, we're finished. This is a negative cash flow. Let's see if we can put net CFI. Negative cash flow of 58,320. Okay, so we can move on to CFF. During the year, we issued common shares. Let's go back to the comparative balance sheet. Common shares went up by 60,000, so we got 60,000 cash. That's positive. We paid off a long-term note payable. And how much money was that? The 5-year note payable went down by 36,000. So we'll record that as a negative cash flow. And more than likely we paid dividends. So we're going to do the same calculation with retained earnings to figure out our dividends. So let's do that. So we have beginning retained earnings plus net income minus dividends paid equals our ending retained earnings. Let's go back to the statements to see our beginning retained earnings was 8,880. Our net income was 104,112 minus dividend amount paid. Our ending retained earnings is 29,520. Okay, so now we can fill in our dividend amount, which is much bigger than it should be, just the way it worked out. 83,472. Usually dividends are a lot smaller than net income amount, but that's the amount of dividend we paid in order for us to get the ending retained earnings there of 29,520. So we will go back and record our dividends paid, the negative cash flow of 83,472. Okay. So our CFF, we add these three items together, so this is net input net cash change in CFF, negative 59,472. Okay, now we're ready for the last three lines. So the last three lines are net change in our cash. We go back to get our net change in cash. We're going to add together our CFO, CFI, and CFF. So start with positive number and subtract these two. Our net change in cash will be $48,960. It's a positive amount. So our cash balance January 1st, and then we'll have cash balance December 31st. Our cash balance January 1st, we go back to the balance sheet, almost finished here. Here it is, $42,000, and our ending cash, $90,960. So 42,000. Draw a line, add these together, and it does work out, so we haven't missed anything. That's your check. Okay, statement of cash flows. Now I want to quickly interpret this one. So I'm just going to scroll, this is going to zoom out a little bit. So how do we interpret a statement of cash flows? First item you should look at. I want to take a look at your net income or net loss amount. It doesn't really matter if you have a net loss, but what we do want to see is let's see, net CFO, is a CFO amount, cash flow amount, that's higher than our net income or net loss. So an example that we did earlier, I'll go to that example in a minute. I think there was one where our CFO was lower. But a CFO that has a higher cash flow than our net income means that we're doing a good job of managing our working capital. And it's just a healthy sign. It means that we're generating cash from our core operations. Okay, so number one, we want our CFO ideally to be higher than our net income amount because it means we're managing our working capital well and our operations are generating cash. Secondly, having a negative cash flow in CFI is actually a pretty good sign because it means that we're investing in our company. So in this case, we sold old equipment. But we bought new good equipment, which means we're improving our equipment in our factory or just our assets in general. So that is actually a pretty good sign. We want to think about where did we get the money to buy this equipment. We got a little bit of it from the sale of equipment, but we got most of it from CFO. That's also a good sign. We want most of our cash to be coming from CFO section. CFF, paying off a loan is a good sign. Issuing common shares, not so great. If we get most of our cash from the CFF section, it's a very negative sign. But in this case, we paid a dividend, that's a positive sign, and we paid off a loan, that's a positive sign. If we have an example, I'll try to show you the next one, we'll discuss it in the next one. If we have a large amount of cash coming from CFF, it means the company is cash strapped, and the only way they can get cash is by issuing shares or taking on more of a loan. So that is just an overview of your analysis of a cash flow statement. I want to go back to the first example that we did. This very simple example. Zoom in a little bit here. Okay, so in this example, we had a net loss. Net loss is not the end of the world, but our CFO cash flow, even though it's higher than our net loss, is still not great. The company's not really generating cash from its working capital or its operations, so not a very good sign. However, they did invest in some furniture, which is maybe what they needed for the company. The real negative signal here is that most of the cash came from issuing common shares. So for the existing shareholders, it meant that the shares are now more diluted because there's more shareholders now for the same amount of net income or net loss. So hopefully the company would have a higher, a net income for the following year, but the CFO needs to be higher than any future net income. So having a high CFF is not a good sign. It doesn't really matter what happens here. So if you're interpreting a statement of cash flows, don't start with these 3 bottom lines. And this is just more for reconciliation, just to show that you've done everything. What you want to look at is the 3 cash flows and where the cash is coming from in the company. One more example I think I'll show you. This is another one that will be posted that we have not gone over today. In this case, there's a net income of $3,000 and CFO of $9,000, so that's good. There are lots of positive cash being generated in the working capital. There was no buying or selling of PP&E assets, which is okay. They paid a good dividend. It's okay that this is negative, and it means they paid a good dividend. They issued some common shares. That's not ideal, but overall, we want to see a nice high amount from CFO, so that was good. Okay, I'm going to leave it there. Once again, this week for your Chapter 10, Professor Baxter will have at least one more example to go over with you. And if there are any questions, please email me. And I'll either relay a question to Professor Baxter or I'll answer it myself. And wishing you the best of luck. Thanks for listening to the video.